housing market has flown off a cliff, but it hasn't crashed yet. Here's the reason why. The purchase applications have been the lowest they've been since 2015. So that's an 8-year low. Lenders have had to get creative and bring back the no income verification loans. It is a tool to help somebody, but there's a lot of risk behind it. One thing that we've noticed is no income verification loans have become more and more dominant. Ninja loans, a lot of people have talked about ninja loans and what are they? And I believe this is part of the reason why we haven't seen some of the home prices decline like we should have. We hit the 7% interest rates. Right now, interest rates are floating right between the 7.1 to the 7.5%. Although the mortgages are unaffordable, houses are still moving. And why is that? Well, part of it is the no income verification. So there's loans out there right now. I'm going to just name a few that we hear about. The first one is if you put 20% down, they won't even look at your income as long as you have a good credit score. Now, the scary thing about this is in the Treasure Valley alone, we've seen an 8% decrease in the median sales price year over year. And it continues to decline. These people who bought houses putting 20% down, no income, if they lose their job or they don't have enough income coming in to make their payments, now all of a sudden they won't be able to sell it like we've seen over this last year. That's for a primary purchase. There's also investment purchases where it's no income verification. If somebody's putting, again, 20% down, they have good credit, they don't even look at your other debts and income. This is a tool for some people, but there is a lot of risk that people aren't even thinking about. Yes, they have to have good credit, right? They have to have good credit. But back in 2007, 2008, did you know that the prime borrowers, not the subprime people with bad credit, but the prime borrowers, which these no income verification loans are geared towards, rate of foreclosure increased, according to this article, 800%. So this is super important that we're following this and we're paying attention to this. This other loan where people can go out and buy an investment property, they got to put 20% down. Again, they're just looking at credit history. So they're not looking at all the other debts that this person has acquired as long as they're putting 20% down and there's a close enough ratio. The scary thing about this loan is the income from the property doesn't even have to be a 1-to-1 ratio. What does a 1-to-1 ratio mean? Let's say the mortgage for the house investment property is going to be $3,100 a month. You don't even have to get $3,100 a month for your rental. It's $3,100 a month. It's a 75% ratio if you're putting, I think, 25% down. Doesn't even have to cover the debt service of that rental. Now these people are going to get stuck. So you add these, it's just a mix for disaster. Because keep in mind, prime borrowers increased the most in 2007 for foreclosures. This is a big problem. This is a big problem for the Treasure Valley here in the greater Boise area, as well as nationwide, as interest rates continue to climb. And not only is the credit card debt over $1 trillion, credit card interest rate has now jumped over 20% or higher. And so people who put stuff on their credit card at 12%, now their interest has doubled and they're drowning in it. They're trying to make ends meet. And the harder that they get squeezed, the more likely we're going to see more inventory because yes, inventory has been low. This is a big problem. Just like the 98% of you that watch our videos but don't subscribe. So if you haven't yet, drop down, subscribe, and hit that thumbs up. Here's something else that I want to bring up. HELOCs. So a home equity line of credit. If you've been on our channel, you've heard us talk about this before, but there was a gentleman, he had extremely low income. Matter of fact, he didn't have income for at least a couple years and he went to the bank. The bank gave him $75,000 on a home equity line of credit without verifying his income. So now he has a home equity line of credit. That's just one of many stories that we've heard over the last month, 2 months, where people are getting these home equity line of credits. Again, these are variable rate home equity lines, just like a credit card. So maybe if you originally opened it at 6%, now with the Fed increasing the rates, now it's pushing 9, maybe even 10% on a home equity line of credit. So these people who pull out this debt with a small payment are now going to increase. And with these increases, people are getting squeezed. Now, the scariest part about this all, banks are trying to find ways to make money. How are they making money? No income verification loans. This is for purchases as well as pulling out a HELOC. And if you can't make your payment, who gets the house? The bank. Another reason why is because some of you are tired of waiting for the housing market to continue to come down. What do I mean by that? Some people have been sitting on cash. Some of our clients that we were even consulting are like, I don't want to wait anymore. I just want to be in a house and not wait for this market to crash. But some of you too have fallen into the trap of marry the house, date the rate. And people were being told the rates were going to come down. The rates were going to come down. Well, now they're actually higher than 7% like we've been talking about. So marrying the house and dating the rate hasn't really paid off and it might not pay off that much longer. And what I mean by that is people are having a hard time living because they're house poor. They bought into this lie of marrying the house and dating the rate, and now they can't afford payments or they're having to tap in their credit cards because the credit card debt has surpassed $1 trillion here in America. And that tells us that people are having a hard time making their payments and living the lifestyle they want. with the delinquency on credit card payments has jumped now to 7.2%. And I know what you guys are thinking. They're putting 20% down. What's the harm in that? There is a lot of equity in the house. But let's look at this house. This house, the only reason why it came on my radar is we were showing some clients some homes. And this house is now pending, according to here, around $550,000. But if you were to jump into the history tab, what you'd see is the house was actually purchased for $680,000. So they have lost $130,000, which is that 20%. These no income verification loans, although there is some safety with the 20% down payment requirement, there's also risk. And so when these people can't sell, or when they can't make the payment and they have to sell and they're selling their equity, then all of a sudden we're going to see a rise in foreclosure. So we've seen in the Boise market, especially if you've been following our channel, in the Boise market, home prices have continued to fall. And a matter of fact, some articles like this one from Deseret says that the Boise housing market has had the biggest decrease in the median home sale price in the nation. And so you really, really got to think before you go in and jump to buy a house. Is this a place that I want to be? Is this something I want to hold on to long term? That squeeze is showing everywhere, from credit cards to people selling their homes for a loss. $130,000 loss, according to this one. So if you're tired of waiting, just make sure you're doing your homework and you're paying attention and you really know where you want to be, especially if you're moving to Boise, as we're still seeing home prices come down. Yes, we saw a little upswing from the seasonality, but in the Boise area, normally around October, the home prices start going down again until January. So be smart, be patient, and make sure you're consulting with somebody who knows the stuff.